If you look at the commodity space and how they've performed year to date, you'll see that both oil and gold moving in very different directions. While the precious metal has been hitting new highs, crude has been languishing as it faces concerns about soft demand and oversupply. For a closer look, we're joined by Andrew Yastrib. He's Vice President and Director and Portfolio Manager with TD Asset Management. Andrew, thanks very much for joining the show.
Thank you for having me.
All right, let's start with the overall view of where we are with the major commodities like gold, oil, and copper. Where do we stand right now?
So as you can see on this chart, so far year to date, this has been a pretty good year for commodities, particularly for gold, which is up 30%. Copper is also up over 10%, not bad as for early September. And Bloomberg Commodity Index is up around 3%. The only commodity that is significantly down, or at least major commodity, is oil, down 8% year to date. What's interesting is that if you look at the performance of commodity equities relative to commodities themselves, they've outperformed significantly. If you look at TSX Global Gold Index, it's up almost 85%, almost triple gold move itself. And for global copper miners, stocks of the miners moved also almost 30%, also almost triple the performance. Even TSX Energy is up year to date to 12.8% when oil is still down. So if you put it all together, commodity index is up 3%. World Commodity Producer Index, which is the companies producing commodities, is up almost 15%. Why is that? Well, part of it is equities overall performed well, so there's a bit of multiple expansion, but there's also a return of capital story, so we're getting dividends, we're getting buybacks, and also all these producers that can grow production over time, especially in this kind of gold and copper environment conducive to that.
Okay, so I want to focus specifically on oil. We're coming out of the summer driving season with weaker demand, as well as potentially higher supply levels. And of course, oil has made headlines recently. What's your outlook for crude right now?
So sentiment on oil is quite bearish right now, which is interesting because, to your point, we've just had summer driving season. Demand so far this year was stronger than people expected. At the beginning of the year, economy is doing relatively well. But as this chart shows, if you look at U.S. petroleum inventories, and what this chart is showing, the green line is the inventories for this year. It includes crude oil, includes gasoline, diesel, jet fuel, and so on. And then if you compare it to the gray area, which is 2023-24 range, inventories higher than they were in previous couple of years.
Much higher.
Yeah, so that's one point. But the other interesting point is, like, if you look at the gray line on the chart, that's the average over the last couple of years. And usually during summer, to your point about summer driving season, inventories decline. The green line over the last couple of months pretty much went sideways, right? So we haven't really seen that pool of inventories that we would normally see. And some of that is just indicator that oil market is more supplied than people expected. Going forward, there are other areas of concern. Obviously, OPEC is a big gorilla in the room in the oil market. And since May, they've been talking about increasing production, revising their quotas higher. So in aggregate, they revised quotas higher by 2.2 million barrels. Some of that is still coming to the market in September. So we've seen the announcements, we haven't seen the actual barrels hit the market yet. On top of that, we also have growth in production elsewhere. So Kazakhstan, even though it's part of OPEC Plus, they're increasing production this year. We also see production growth in Brazil and Guyana, where there's new fields that are starting up as we speak, and into the end of this year, we'll be producing additional oil. In Canada, we see growth. And then on top of that, as we talked about summer seasonality, in US, Europe, we see driving season during summer, increase in demand. But there's also another part to that seasonality. In Middle East, during summer, it's really hot, and they use oil to generate electricity to power air conditioning. So that is coming to an end as well, which will release additional barrels to the market that can be exported instead of used domestically.
Is the OPEC decision the biggest factor, the big gorilla in the room here that could impact overall demand and prices in the long run?
Yeah, excuse me. I believe so. I think if nothing changes in OPEC policy, it looks like market will be oversupplied going into end of this year and beginning of next year. Is OPEC going to change their policy and say that they will defend some kind of floor on oil prices? We don't know that. So that's one thing to keep in mind and watch out for.
Yeah, something we'll be watching closely. Meanwhile, it's a different story for gold, which not only have we had a pretty strong rally, as we've seen today, you say that there may be very more room for gold to move.
Well, nobody really knows where gold is going to move. Nobody has a perfect crystal ball to give you all the answers. But when you look at where gold is right now, it's up 30% year to date. If you look at this chart, it shows 3 cycles. And the idea behind this is like I wanted to see where gold could move, right, in what kind of environment it would take for gold to move higher from here. So the yellow line shows the performance so far over the last 10 years from the bottom in 2015, and gold tripled. So if you bought gold back in 2015, you did well, congrats. The question is, going forward, is there more room to go higher? And the other 2 lines here are really interesting. So the blue line is the last cycle, started in 1999, ended in 2011. And those years are really interesting because in 1999, the environment was quite different from where we are today. There are some similarities. Back then, it was late kind of quarters or months of the dot-com bull market. So everybody was buying Nortel and Cisco instead of gold, and it made sense at that, in that environment. It was also different from macro perspective because US government was running surpluses, not deficits. And inflation was under control, but the market was getting a bit too hot, and the Federal Reserve was increasing rates. Now we're talking about decreasing rates. So that was in hindsight, it was the perfect time to buy gold back then, and then wait until it increased by 7 times. So for us to match that kind of increase, gold would need to double from here to move to 7,000. But the end of that cycle in 2011 was the European financial crisis. So if next few years, if we have probability of some kind of financial crisis happening anywhere in the world, that's what it would take for gold to move there. I think the other line on the chart was interesting as well. That was the 1970s, right, when we had hyperinflation, when we had a Fed that was too friendly to politicians, not fighting inflation enough. And back then, gold went unbelievable 19 times from bottom to top. Obviously, to move that much, like gold would still need to go 6 times. I don't think anybody is calling for that. But there's also some similarities to that environment. We're talking about Fed independence, right? We're talking about tariffs and inflation rate going forward, which again, nobody really knows how it will play out here. So for all those reasons and all those moving pieces, I think there's still a good reason to be overweight gold here.
And does concerns over the U.S. government's federal debt issue, as well as potential interest rate cuts, could that act as a tailwind for gold going forward? You mentioned interest rates, obviously. But...
So interest rates, absolutely. So if you look historically, one factor that significantly moved gold in the past was real interest rates. So if real interest rates come down, then investors don't see as much value in bonds or other assets, and the gold becomes more attractive, right? So the gold outperforms in those environments. If inflation surprises to the upside, that would push real rates lower. If we have rate cuts, again, real rates will be coming lower. That's all positive for gold.